Back with closing trades right here on ET Now, and you're coming, just watching us live from the SBI Live studios. Let's just revisit what the market is currently at. Still got an hour to go before we wind up for the trade, a little less than that, and we are managing to hold on to the greens. 24,750 is where we're currently at when it comes to the Nifty futures. Although, of course, the biggest stars are today within the broader end of the market. About a count of 173 actually standing to the greens within the F&O universe. IIFL, Samman Capital, 361. These are the names which are actually holding up in trade. So the capital market theme clearly continues to ride the structural move. HPCL, Petronet LNG, BPCL, these are some of the other names which are also looking good. Look at the panic which is set out around that whiff of tariffs perhaps in electricals. Dixon, Keynes, all of these stocks are the ones which have been down and out from the word go. And then, of course, you've got a Mazgaon Dock, Axis Bank, Solar Industries, etc. They are some of the other laggards as we speak right now. But L&T, that's the one which is also in focus. And Bank of America has downgraded the stock to an underperform with a target price of 3,700, saying that most of the positives are already in the price, leaving very little upside on the table. Let me take it across to Kanishka and find out what exactly does that note entail.
Well, yes, L&T shares are in the spotlight today and they are under pressure as Bank of America has downgraded the stock to underperform with a target price of 3,700 rupees, saying that the most positives for this company are already priced in, leaving very limited upside for the stock going forward. Now, the brokerage notes that while L&T was their only buy in the industrial space back in August 2024, thanks to strong order inflows, earnings visibility and fair valuations, since then the stock has significantly outperformed, even rising 10% in just the last 2 months. On the positive side, L&T's exit from Hyderabad Metro Phase 1 through a Telangana government acquisition is seen as a key portfolio cleanup. However, the deal is EPS and ROE accretive as per the brokerage, prompting a 3 to 4% upgrade in FY26 to 28. That's the earnings estimate upgrade. Apart from that, however, BofA warns of headwinds going forward. It says that domestic capex is going to sharply decline from 20% CAGR in FY21 to 24 to just 11% in FY25 to 27. Now, this could disappoint consensus expectations of a government-led revival. That's the word coming from the brokerage. And adding to that, L&T faces Middle East risks with potential slowdown in orders and execution as subdued crude prices weigh on capex demand in the region. So in all, Bank of America says that while the Hyderabad Metro exit boosts profitability for L&T, it believes that the near-term upside is capped and hence it has downgraded the stock to underperform.
Excellent. Thank you so much for getting us that perspective. Let's though move on. India's festive e-commerce season is off to a blockbuster start. E-commerce GMV has crossed over 60,000 crore in just the first week, and this is according to Datum Intelligence. According to the retail or across the retail segment, grocery and appliances led the charge with over 40% each. Anjali is here with all of the trends giving us that perspective. Anjali.
Right, so we are 1 week into the new GST changes coming into effect, and it was also the start of the festive sales. Let's take a quick look at how e-commerce sales have performed. They've crossed a GMV of 60,000 crores, and 51% of the festive sales has been taken on by the first week itself. In fact, just the first 2 days of these festive sales on 22nd and 23rd September accounted for 33% of the sales that happened this week, and we've seen a healthy growth of 29% year on year. This is with regards to the e-commerce part of the business. Now, they've seen a very high growth in grocery, which largely was driven by the quick uptick of quick commerce, and appliances, which saw a bunch of GST cuts coming down from 28% to 18%. Their 40% growth, 41% growth was also registered. Consumer electronics, again, 34%. Other than this, the other categories that saw a good amount of growth was homeware and furniture. Smartphone, which grew by 27% year on year, but was the largest category with the highest amount of sales, in fact, in e-commerce this year. Lifestyle and personal care, again, at 19%. But let's now take a look at what's happening offline as well as in retail stores. So appliances for Vijay sales was 2x the number of sales versus the weekly average that they see. The festive sales forward contributed to about 20 to 25% of this growth, and a strong trend of premiumization was seen in TVs, where TVs above 32 inches saw a big GST cut. And in terms of FMCG, they saw value growth of 4 to 5%, but the volume growth was higher at 10 to 15%, and that's what things are looking like in the first week of the GST cuts as well as the festive season.
So much for that, Anjali, and opportune time to ask Kunal whether he's actually buying into consumption stocks, into some names, or is he actually just consuming? Kunal, what is it that you're doing this Diwali? What are the ideas?
Yeah, consuming is going on. Consuming is going on, but not too much into consumption stocks as of now. No major patterns over here. And I think I said this, the FMCG stocks have been one of the huge underperformers in this last 1,500-point rally and then this correction. It's just that maybe, because the sector has been beaten down significantly, you're not seeing an incremental sell-off in the last couple of days, where the intensity of sell-off has been a little bit more higher in terms of other sectors. So that's the off effect for the FMCG, that they are not participating on the downside. But then whether this translates into an upside for the entire sector, that I think is it's still a wait and watch.
Okay, and it seems going by the market trend, a lot of consumption within the primary market as well, looking at the IPO subscriptions. Let me welcome on board then Manish Memani, the chairman and MD at Ganesh Consumer Products, to talk about exactly that. Ganesh, great to have you today on ET Now, and congratulations on your listing firstly, with the IPO now raising about 409 odd crores. Tell me, how soon do you plan to deploy the issue proceeds, particularly for debt repayment, capacity expansion? Where will the proceeds go?
Right. So with the primary proceeds, what we are raising of nearly 408 crore rupees, it is going, debt of 60 crore is going to be repaid, and a new manufacturing facility will come up. 45 crores will go into it in West Bengal, and nearly 25 crores will be used as a general corporate expense.
Okay, and Mr. Memani, this is Harsh here. What are your margin levers going forward? Would it be premiumization, scale, cost efficiencies? What is it that's going to aid the margin number?
So all three, if you ask me, of course, we are a mass category brand. We are available at all economic points for the society. But then premiumization will be our ambition. Of course, we are going to premiumize some of our core categories. That is one. And if you ask me on other than premiumization, we are going to come up with more optimization of our current supply chain and production, more sustainable packaging. We will be going for, some of our plants is going into installation of solar modules also. So I think all around eyes will be there on the category side also, on the optimizations also, and on the revenue growth also.
Right. And Manish, lastly, GST has seen a cut across a range of product categories, but wheat flour is still taxed at 5%. How much of your portfolio stands to gain then from GST cuts?
No, so currently where the categories where we play, snacks is a very small portion of the overall category. So overall on the margin side, we will not get too much of advantage. But then with the general buoyancy within the customers, I think the general euphoria is going to advantage all the branded packaged staples.
Okay, Manish, great to have you on the show. Thanks for your time today. We'll take a very quick break. Come visit where the closing trades are settling in at. Well, it's not really a concern for the broader end of the market. That's been doing well. It's the Nifty which hasn't really found its feet, because as we speak right now, once again, we've given up all of our morning gains and about to dip into the red, just barely standing in the green as we speak right now. Having said that, some of the capital market themes are still going very strong. Sammaan Capital, IIFL, 361. These are all looking good. From within the large caps, Indocin, Titan, Hindalco, Wipro, Tata Steel. While you can't really draw any trend, so to speak, some of the large caps are still holding the ship and managing to put up a good tug of war, so to speak. Axis, on the other hand, is down. L&T has slipped down about 0.7%. Adani Ports, HCL Technologies, Infosys, TCS, Bharti are all beginning to flatten out as we speak right now. But let me welcome on board the management of Atlanta Electricals now. We've got Niral Krupesh Bhai Patel, the chairman and MD, joining in on the show, and also Akshay Kumar Mathur, the CEO at Atlanta Electricals, on the show. Congratulations, Niral. Firstly, you're listing. Tell me what kind of growth and margins outlook can one see in the coming years, and what sort of levers for growth do you anticipate?
So, sir, thank you so much for congratulating us. In fact, the company had a fantastic run, fantastic marathon for the listing activity. We are estimating that the growth will, we have grown historically year on year on 40%. The margins were close to about 10% PAT levels. We are expecting to keep that same winning streak so that we are able to contribute the best to the investors.
Give us the growth outlook, sir, for the next 2 to 3 years. How does that look?
Actually, we already have 2 facilities now, which are already started working. So next 2 to 3 years, our plan will be to use those capacities to fullest, and that would be the plan, and go up to 765 kV transformer and reactor range.
Right. Niral, any further capex plans going forward in the coming years?
We have already quadrupled our capacity before we hit the market. So our intentions would be to first serialize those facilities, make optimum use, show a reasonable growth to the company, and then go ahead for the capex. However, small capexes are planned, but that is for backward integration, not for transformer manufacturing.
Sure. And Akshay, could you give us a breakup of the order book, both domestic as well as international, and how the client confidence and demand is looking for export players especially?
We are not in export market as on today, but we will be doing exports. Exports will be our focus for the years to come with the new facility. But nationally, we have order book of around 16,200 crores with us. And this is 66% of state utilities, and balance is private players.
Okay, and Niral, any product category launches expected this year in particular?
Certainly. So this industry is always requiring continuous innovation. So we would be entering into the 400 kV space. That is higher end technology to manufacture large rating transformers, extra high voltage transformers. That will be a new product to our kitty, which will open up new customers for us. At the same time, we will be also developing 765 kV class transformers and prototyping that as well. That would also add a certain market reach and additional customers to our kitty. These are highly technical products. They take a little long time to prototype. We expect the first prototype of 400 kV in the last financial quarter of this year or the first quarter of next year.
Okay, gentlemen, both of you, thanks for joining in, and congratulations on your listing once again. Let's move on, and before that, let's just talk about Moody's India outlook. They've affirmed the Baa3 rating. They've kept the India outlook for stable. But just one red flag, and they're stating that the tariffs are impacting the capacity to attract manufacturing investments. Manufacturing, in any case, has been a lag, and from a market perspective as well, the big debate has been post the GST rationalization on whether or not to have the tilt out of capex and into consumption or not. And now Moody's also flagging that because tariffs is still such a big overhang, and India and US have not yet been able to come to a resolution with regards to that, so attracting capex would be a little problematic. But let's move on, and let's get you another piece of ET Now exclusive. And sources are telling your channel that the Oil Ministry has sought the cabinet nod for amendments to the PNGRB Act. My colleague Prakash Priyadarshi joins in with more details on the same.
Well, in a move to carry out major reforms in the oil and gas sector, the Oil Ministry has sought cabinet nod for gas marketing and pipeline infrastructure reform. So very significant development coming in. In fact, the ministry has sought cabinet approval to amend PNGRB Act that will cover infrastructure and gas marketing reforms for all energy sources, which include green hydrogen, green ammonia, ethanol, compressed biogas, and so on. A very significant development coming in. The proposal on which the ministry has been working for quite some time has now been sent to the Indian cabinet for approval. We're given to understand that the PNGRB to be empowered to regulate gas pipeline infrastructure for all type of energy sources. Transport system operator, which is called TSO, will be formed to manage all common carrier pipelines in the country. TSO to be brought under PNGRB regulation. Sources are also indicating that the GAIL's pipeline infrastructure, along with other companies, to be included under a TSO framework. Government will retain majority stake in transport system operator, where PSU such as ONGC, HPCL, GAIL, IOCL, EIL may hold equal minority stake in the company. The objective is to create a system where level playing field could be provided to the industry.
All right, thanks so much for that, Prakash Priyadarshi, on that piece. But we're also joined in by Ashi Anand, founder and CEO at IME Capital, to talk to us about markets. Ashi, great having you here. I want to first start off by getting your sense on, some of these OMCs, because we've seen such a strong buzz around that, and it's a very unlikely kind of sector to start a conversation with. But given the buzz, I'm trying to understand what's your sense with regard to some of these names. And of course, there's been a Jefferies report which has also come through, which seems to suggest that there is plenty of push coming in from the Ministry of Petroleum and Natural Gas to push up or likely get better valuations for OMCs. Do you believe that OMCs are undervalued? Give us that perspective.
Sure. Firstly, thanks for having me on the show. OMCs are very interesting. They clearly are relative to kind of global private peers. They would be trading at significant discounts to what other kind of OMCs would be trading at globally. And this would be because of clear risk of government interference. Whenever oil prices move up quite significantly, there are fears of kind of subsidies. You've not seen this for many years now, but you have had that historically. There are various parts of kind of pricing which is not necessarily completely in the kind of company's control. And the moment you have a situation like this, you would have investors having fairly large discounts being applied. Now, the more you move towards deregulation and the clearer you kind of have regulations around various aspects of the kind of entire OMC value chain, that would be kind of instrumental in helping value get re-rated. You have seen, if you kind of go back historically and you go back to kind of the 02 to 07, 08 period, that was the first major wave of kind of oil price or oil deregulation or deregulation in the entire sector. You saw a lot of value creation happening at that point in time. At that point, they had actually started at abysmal valuations. Valuations now are at a discount, but not necessarily very, very cheap. We see kind of regulatory framework improvements and clarity as helping kind of valuations improve. However, we continue to believe OMCs are likely to be a bit more of a trading play. One, because structurally kind of the world is moving towards renewable energy, and the longer term longevity kind of valuations of these companies are a bit suspect. The second core element is that even when there is kind of some positive improvements on deregulations, I think investors are maybe a bit suspect about how long this could kind of continue and how long a deregulated framework could hold in terms of in cases where there's very high volatility in oil prices. So yes, there could be a kind of a play here, but not necessarily long term. And we really have to see what the eventual kind of regulations are going to be, how the industry is going to shape up. But there is definitely an opportunity.
The other buzzers, and some of them we were speaking about, Aisha as well as Kunal, are something like Godfrey Phillips up 7%. You've got a Reddington up 7%, a Wockhardt up 18%, a Saman Capital up 12.5%. Any of those on your radar, Kunal? Any of those looking interesting to you?
Yeah, I think Godfrey is something which looks interesting. In fact, the setup for the stock, the outperformance with respect to its immediate peer, ITC, I think has been quite stark over the last many years. I remember, I think Godfrey Phillips was somewhere around 1400, 1500. 2023-24, and from there the stock had started a massive rally for itself. I think it doubled in a matter of just 8-10 months from that 1500 kind of a mark, or the point when the rally started off for the stock. I think even on the short-term charts over the last 2-3 months, the stock has gone through a zone of a consolidation. It's retested the support just around the 3,300, 3,400 mark, which is also the low the stock has made over the last 4 or 5, in this last 2-3 months, in 4 or 5 attempts. So I think in that sense, I think it's a good risk reward to look at Godfrey Phillips at current levels, because the longer term charts is still very bullish. Short term wise, the stock has come back towards a good support point.
Okay. What one can also see is some of those EMS plays come down quite hard. So look at a Dixon, Keynes, etc. They're some of the top F&O losers, in fact. And actually, I guess, just a whiff of perhaps tariffs coming next on electricals, that's sort of putting pressure and weighing heavy on the sentiment around some of these names. Do you think, should they crack even further, they could be buys? Or would you say avoid till you have some clarity on what Trump plans to do with tariffs and electricals at large?
Sure. So, see, any kind of trade which is a play on a 0-1 event, right? What is Trump going to do on tariffs in this particular segment? That is inherently kind of quite risky. And from a conservative stance, you'd always kind of indicate that wait to have clarity on longer term business economics before taking an investment call. I think that core principle only kind of the only way you can avoid having to wait for clarity is that if the level of discount that you're getting is so significant that it kind of from a probability adjusted perspective, the kind of valuations are seeming so cheap that it is actually factoring in worth the most of the downside and not too much of the upside. But I think by and large, it's a space that we would kind of wait to kind of see what's happening in terms of clarity. There are so many moving parts when it comes to kind of global trade. You don't know kind of what's going to happen, both in terms of import tariffs into the US, import tariff of other competing nations into the US, what kind of tariffs we are going to be implementing across different countries. There's just too many moving parts at this point in time to have clarity around a view. That said, evaluations keep becoming cheaper and cheaper. I think you will see some amount of bargain hunters coming in. But the moment you're kind of buying into a company, even if it's fallen significantly, where there is kind of upcoming news, that news will obviously have a big impact. We would actually recommend staying away.
Okay, stay away. But Kunal, on the charts, do you foresee more pressure for Keynes, Dixon?
I think this could be a interesting juncture where I believe that these stocks would actually come back to a good risk reward buy, because Keynes apparently till yesterday or day before, I think that means till Friday last week, I think was actually sitting at a fresh multi-week high 7,300 400 levels. So this could actually be a good correction to really participate in case if these stocks provide another 3 or 4 percentage points correction, because there are two aspects which you look out for. One is the resilience of the stocks in the heat of the market correction, and the second is that these stocks, they hardly go into this kind of a V shape or a sharp corrective phase. They're prone to more of time-wise consolidation rather than a major price correction on an immediate basis. So I think I would actually look out for, say, another 3 or 4 percentage points if it happens for downside for Keynes Tech, say somewhere around 6,700 to 6,900 kind of a range. That actually becomes a good territory for contra traders to go in for a buy.
Ashi, Anand, curious to know your view with regard to a metal index, and it's been such a strong rally by the metal index. The outperformance has been extremely sharp. Give us your perspective. Is this sustainable? Do you expect that valuations have now reached a point where they're fair? How do you see that?
Oh yeah, so if you're just looking at kind of the metal index, right, and we keep precious metals out. If you're looking at the kind of the steel, the aluminum, and some of the kind of industrial commodities, we don't have a very strong long-term bullish view out here. And I think the primary reason behind the lack of a strong positive view is that ultimately most of these global commodities are all driven very significantly by demand and supply trends coming out of China. In an environment where there's a lot of moving parts in terms of the global economy and global trade, China has not been a key driver of incremental metal demand for a few years, and that's been because the Chinese economy has been slightly weaker. Uh, at this point in time, you don't have clarity around a strong rebound in metal, and I'm talking of more structural kind of rebound in metal demand coming out of China you would need very aggressive infra and real estate spends to kind of come in to for China to be that incremental driver of demand. So if you don't have kind of China being a key demand driver globally, there aren't enough other countries which can kind of drive demand to an extent to lead to a demand driven price increase. The main concern we have from China is that if the Chinese economy is relatively weak, a lot of the kind of environment linked production cuts that they had implemented as they were trying to improve their environmental and various other issues around the environment, some of those production cuts may actually see a bit of halting in an environment where the kind of economy is weak. You may not actually be as aggressive, and this could lead to certain supply coming back. So we prefer to kind of participate in metals when there is a longer term structural or bit of a secular bull run that we're seeing in metal prices. That is something which, at least in the near term, we're not seeing given the kind of various elements around weakness of economic growth globally.
Right, absolutely. Kunal, the previous speaker was also talking about from Ambit Capital that perhaps some of these contra plays in the markets look good. I was just looking at the block deal on Infosys. Would you at all venture to take that punt on Infosys, TCS, etc.?
So now the price is coming back to a very attractive territory, Aisha, because there was a point where we did a ratio analysis on sectors. Like for example, in 2024, there was IT, FMCG, and I think other few sectors like PSU, specifically defense, etc., which were at the much higher end of the price curves with respect to many of the other sectors relatively. Now, the ratio analysis chart actually shows that many of these sectors, the underperforming ones, and specifically IT, to an extent FMCG, I think these sectors are at a huge curve on the downside for themselves with respect to the last 3 months, 6 months, 1 year kind of a price analysis. And look at the extent of beta correction for these stocks. TCS is not a stock which generally falls by 20-30% or rises by 20-30% in a matter of 12 months or so. But for the stock to fall from 4,500 plus kind of a mark towards sub 3,000 mark, that itself indicates that it's a very sharp kind of a correction for the stock. And same is the case with the other large cap names like Infosys, etc. So I believe that now we are in that phase of a major transition where the beta of these stocks have changed, the valuation, the price-wise, parameters are at an extreme oversold territory. In this scenario, yes, the trade looks attractive to go for a contra buy, but then we just wait for one confirmation. Like if these stocks move up higher by 5% higher from their swing lows anytime, say over the next 1 week, 10 days, that becomes a point of strong confirmation because then the risk reward is in your favor at that point of time.
Okay, we will wait for you to give us that confirmation when you get one. That's, of course, the take coming in on Infosys TCS, wherein Kunal believes that the risk reward definitely looks a lot more favorable than it has perhaps in the last year or so. Ashi, where else are you finding or scouting for opportunities in this market?
So it is a difficult market because I think you are still still a lack of clarity around what is going to be the key driver of kind of the markets going forward. If you go back 2 years ago, there was a lot of clarity around which were the kind of sectors or segments which were kind of driving overall market performance. Over the last year and a half, you have seen a fair degree of rotation. At this point in time, we kind of believe that in the near term, consumption and consumer linked plays are likely to kind of drive some amount of market outperformance. This is driven by the combination of the fact that you've had income tax cuts, you've had GST rationalization, and you also have interest rates having been reduced. All of these should help increase the money in the hands of the urban consumer, urban and rural consumer, and that should lead to some amount of a recovery in consumption. We also continue to see a lot of value in banks from a longer term perspective. We are aware that in the near term, there is some amount of growth, asset quality, and NIM pressures, but all of these seem manageable. And if you're looking at kind of the valuation, growth, quality, kind of the combination of all those three, you can get some very high quality banks trading at kind of reasonably attractive valuations with kind of longer term growth visibility. A lot of the other sectors that you're kind of looking at, with the exception of kind of banking, with the exception of consumption, and with like digital is something that we clearly have liked and continue to like over the last couple of years. It's clearly our biggest weight. But X kind of that, a lot of the other sectors either have challenges around growth, and you need to kind of have greater clarity on the growth recovery in order for those sectors to start to outperform, Or you have segments kind of like real estate, capital goods, capital markets, where these companies have kind of done quite well over the last 2 or 3 years. The growth outlook is fairly decent, but valuations are expensive, and you probably need some amount of time correction before these become attractive buys. So I think at this point in time, it's more kind of digital banking and consumer that we're kind of focusing on.
So that's the take coming in. Ashi, if I can just extend that part of the conversation, try and get your view with regard to PSU banks before I go across to Kunal, because top sectoral gainer today, but outside of that, that's one of the other pockets of resilience in this market, especially over the last couple of months. What's your sense like, and do you believe that this kind of dream run can actually extend itself for a little while more?
Yeah, so I think our view on PSU banks is quite clear. We prefer private sector banks from a longer term perspective. So if you're buying and holding something in your portfolio, I think clearly over the longer term, you will see outperformance on private sector banks. PSU banks, according to us, are a case of a valuation catch up. There was an extended period of kind of outperformance, of underperformance between 2005 to 2020 to 23. Over the last few years, you have seen some amount of the valuations catch up. But as kind of as PSU banks continue to improve their performance, you have seen some of them come back in terms of growth. Asset quality is no longer such an issue, and they kind of overall ROEs, ROAs, the overall economics also improving. In that context, we believe there is a valuation re-rating play that one can kind of look at when it comes to PSU banks. But from a longer term perspective, we'd much rather play the longer term consistent compounding that you get with some of the higher quality private banking franchises. Because the moment you kind of have this valuation re-rating of the PSU banks, the underlying earnings growth of these companies aren't as strong. And which is why, for a certain shorter period of time, if you PSU banks may continue to be an attractive play, but longer term, we clearly prefer private banks. Even when it comes to PSU banks, we believe there is a pecking order. We believe SBI is almost a bit of a blend between the private sector and the public sector. It's probably amongst the best run PSU banks. We prefer kind of a high quality PSU bank like SBI as compared to some of the others.
How much of this re-rating is complete, Ashi? So I understand that from a long-term perspective, private banks over PSU, but I'm trying to get to the point that we've seen a 30% rally from the lows of February 25 in the PSU index. You also seem to suggest that there is some value which PSUs still need to go up by. What is that? How much of the re-rating is complete? How much do you expect to play out?
So in our estimates, a fairly large part of the re-rating is complete.
Okay.
We'd probably say 80 to 85%. You obviously can't be too precise here, but according to us, the very large part of the re-rating is complete. You can still possibly play some amount of it, but the big move is done. And we're talking in relative terms.
Your take on the PSU banking index?
See, I'm very bullish on the PSU banking stocks, Harsh. In fact, my belief is that what we saw in 2022 to 2024 was a period where many of the PSU banking stocks gave returns of 50%, 100%. Some of them, the mid-cap funds, gave returns of more than triple digit. I actually believe that maybe not a similar phase, but a similar kind of a time-wise, uptrending is what we are seeing at the start of this, fresh move for many of the PSU banking stocks. And the best part is it's led by a large cap name, and that is in the form of SBI. You've seen a massive breakout coming out for SBI when the stock has broken past about that 820 barrier, which is a huge multi-month resistance for SBI. And then the move started to trickle into the other PSU banking names. You look at PNB, Bank of Baroda, Canara Bank, I think has been a very strong performer, Bank of Maharashtra, etc. So I think with all of these stocks coming together at the time when you have sort of a leader established in terms of a price performance, that augurs really well for the entire sector. And then we also look at it this way, that over the last, I think, 3-4 months, or maybe a slight more extended period than that, the PSU banking sector was a huge underperformer. I think if you look at the underperforming sectors and you make a list of the 3 underperforming sectors, PSU bank used to feature out in the last 4-5 months of this last 6-7 months of the price correction. So that also is playing a strong mean reversion for the PSU banking sector. So whether you are a 3-month investor or the next 3 years, I believe current levels, PSU banking stocks selectively, I think are very good buys.
Excellent. Okay, so we've got two calls coming in on the PSU banking space. But Kunal, I'll stick with you. Give us a perspective also on the Nifty India Defence Index and more particularly Cochin Shipyard. That one is down 6.5%, and this is on the back of what has been already a very difficult week for the Nifty Defence Index. It was down, I believe, nearly 5% through last week. Another 1.5% shave today.
So I think on the Nifty Defence Index, I actually believe that it's a good index to look at from a long-term play. Now coming straight to that, move in Cochin Shipyard, so this is more of portfolio adjustment or trading adjustment style which one has to do. When the markets are into a fine fettle, it's always a very good strategy to play trading strategies into these stocks from a short-term arena. The moment you see the markets going into any zone of volatility, you have to shy away from these names, because historically, you look at the last 2 years, you look at the last 4 years, these stocks have had massive amounts of volatility. And Cochin Shipyard is one of those stocks which was almost at 2,500. I think recently, and the stock has come back towards 1,500 mark. You look at the last 12 months of price performance from 3,400. The stock has twice gone to a 30 to 40% correction. Now that's not a very small number to digest when you look at this in terms of the extent of volatility. So I would stay away from these names as of now. But if I have to bet on the defense pack, one has to look out for names like BE and HAL. They are far more stable, far more stronger. And if you're looking at any kind of a major trend developing, these are the best bets which one can find into the entire sector.
Right. Kunal staying consistent with what he said today morning. So viewers, if you were with us, you would have got the same advice in the morning. Ashi Anand, what's your take on defense very quickly, because I have one more quick theme to cover.
Sure. So defense is clearly very, very attractive longer term. I think I broadly agree. If you are looking at defense, some of these companies are a little more stable, a little more diversified. Companies like a Cochin Shipyard and certain other defense companies are extremely kind of dependent on a few large orders, and any kind of delays or preponements in those orders can lead to very large volatilities. We see this as a very attractive longer term theme, probably be diversified a bit, try to be with some of the safer names. But India does have the second largest importer of arms in the world. We used to be the largest before Ukraine. There is a big indigenization program which is underway. We are at early stages, and therefore we see this as a multi-year opportunity.
EMS plays, because today you're seeing Dixon under pressure, down 5%. Now, no, I'm fully aware that this is extremely volatile in any case in terms of the stock price performance. But talk to us a little bit about, are these buying opportunities for something like a Dixon? I know it doesn't trade cheap, but at the same time, is the opportunity large enough? Margin expansion is what they've spoken about. Top line growth, not a concern. Your sense?
So someone like a Dixon specifically, I think one, like we had mentioned, we are kind of watching on what's happening on trades and tariffs, right? Because one of the key elements of trades and tariffs is that, is there then a kind of a requirement for some of the other global companies to actually set up their own shops? Some of Dixon's customers, if they come in and set up their own facilities in India, if at all becomes required for some reasons or the other, that is actually a key risk for kind of Dixon, and that is something that we do monitor quite closely. It is important to understand that while Dixon has done incredibly well over the past few years, valuations are incredibly rich and are really factoring in a lot of this very strong execution continuing going forward. At these kind of valuations, we tend to be a little uncomfortable. It's more valuations and honestly the fundamental story, which is quite strong.
Understood. Point taken. Thank you so much, Ashi, for joining us. Thank you so much, Kunal, as always, for being with us. Let's go across to Snehi, who's there with all of the action that